Jerry Forente and Susan Montgomery are business partners who provide financial and personal services, but here's the important detail. Neither of them is personally responsible for the company's debts. That right there is the biggest clue that their company is a corporation. A corporation is different from sole proprietorships or partnerships because it is a separate legal entity. This means that the business exists on its own apart from the owners. Corporations are usually chosen when a business requires large amounts of investment or when the business is willing to take on higher risks. For example, if Jerry and Susan want to grow their business, hire more employees, or attract outside investors, a corporation gives them the structure and flexibility to do that safely. Some benefits of a corporation are, but not limited to, is limited liability, which could be considered the most important advantage. If the corporation takes on too much debt or is sued, Jerry and Susan's personal assets, like their homes or savings, are protected. Only the corporation's assets are at risk. Business continuity. Unlike a sole proprietorship, a corporation does not automatically end when an owner leaves, retires, or even passes away. Shares can be sold or transferred, and the company keeps going. This makes corporations long lasting and able to continue smoothly across generations. Tax advantages. Corporate tax rates are often lower than personal income tax rates. That means profits left inside the business can be taxed at a lower rate than if Jerry and Susan reported them on their own tax returns, like other forms of ownership. Easier access to capital. Corporations can raise money more easily than other business types. They can borrow from banks, attract outside investors, or issue shares. This gives them more financial power to expand. Credibility and structure. Because corporations follow a clear hierarchy and legal structure, they are often seen as more professional. This credibility can help them build trust with external sources. But there are also drawbacks to corporations. For example, they take more time and money to set up. Incorporating requires legal paperwork, government filings, and annual fees. There's also problems such as double taxation. First, the corporation pays taxes on its income. Then, when shareholders like Jerry and Susan receive dividends, they have to pay taxes again on that money personally. Additionally, corporations also face heavy regulations. They must keep detailed financial records, file annual reports, and follow strict rules. Finally, there's the issue of limited control. In some corporations, the shareholders don't directly manage the company. Instead, a board of directors or managers make the big decisions. This separation can be frustrating if the owners want more direct say. Additionally, corporations can be either public or private. Public corporations sell their shares on the stock exchange, which means they can raise large amounts of money from many investors. But this also brings stricter government oversight and less control for the original owners. Private corporations keep the ownership in the hands of a few people. They don't sell shares to the public, which means more privacy and control. So, in conclusion, by being a corporation, Jerry and Susan protect their personal assets, ensure their business can continue long term, and make it easier to raise money. But at the same time, they face higher costs, more rules, and a more complex structure. Understanding these trade offs is key because ownership structure affects not only the business's finances, but also how we record and report them.